In today's video, I'll be doing a full macro breakdown on the entire US stock market. Now, let's get into it. The first thing that I want to be showing you guys is the complete US macro. First, we're going to talk about is GDP. The GDP just printed, and it's clear the massive explosion from AI investments is cooling off. We're not in recession territory, but the easy growth phase is definitely behind us. Inflation, core CPI is sitting at around 2.5%, and the street expects it to stay there until late 2026. But if oil keeps climbing, that number is going much higher and will do so very quickly. The Fed rates, it is very hard to predict. There's no cut this week, but on Polymarket, the odds of zero cut rates for the rest of 2026 just jumped to 31% because of sticky inflation and tariff worries. One bad oil print and the whole rate cut narrative disappears, and we will be stuck at the same inflation rates. At the same yield rates. Now, if you want to take a look at this, you can see that the US GDP has slowed and has continued to slightly decline. We are at about 0.7% right now, and it seems to not be growing and to be slightly lowering at a pace. The Fed Watch rate forecast is 25 bips by end of year, like I mentioned, but this is slowly coming down each month. And now let's talk about the geopolitics in Iran. New headlines have come out every single day tying the war to oil supply. The best case, which is very unlikely, is that this war ends in the next 3 to 4 weeks and the market rips higher. But realistically, this war will likely drag on another 2 to 3 months, and oil will continue to rise, and basically everything except oil companies will get hurt in the process. And this is the biggest wild card in the markets right now, as nobody really knows what's going to happen. If we take a look on Polymarket, we can see that there's only a 5% chance of the Iranian regime falling by March 31st, which is very low, and only a 71% chance of a ceasefire. So yeah, market's basically pricing in that there won't be that many, or that the war will take a while, and it's also kind of saying that they think that the U.S. will be forced to enter Iran by land, which will probably make the conflict much worse. Now, let's talk about the tech macro. AI CapEx is still the biggest tailwind we have in this sector. Trillions are being spent, but the market is starting to ask the tough questions. How sustainable is this pace? And some big private credit funds are already pulling back on lending. Remember, tech usually leans to the downside, so if the broader market starts rolling over, tech is going to get absolutely hammered first. So stay sharp. And if you want to take a look at how the tech sector has been performing, we can take a look at the State Street Technology ETF, which, as you can see, it has basically just been consolidating for a while and has dropped back from its highs of 150 and is now is down about 10%. As you can see, over the past month, with all the uncertainty that we have had in the war, it has basically just been chopping around into this big range right here. And especially within the past couple of days, it has just come into this and hasn't really bounced anywhere. We had a huge run up, ever since the tariff, when it was all the way at 80, and it just shot right up. But it just started pulling down in recent months with all the with all the geopolitical fears. Now let's talk about the healthcare macro. Honestly, this one is looking the best in my opinion. People will always need healthcare no matter what the economy is holding up. So it holds up beautifully in slow growth environments. On top of that, AI is finally starting to improve margins and cut costs. Earnings have been crushing it, and I would not be surprised at all if healthcare is one of the best performing sectors over the next couple of months. So now we can also take a look at XLV, which is the healthcare Spider ETF, and as you can see, while tech has been underperforming, this sector has been breaking out. As you can see from August, it has risen about 25%. And although it took a beating over the last couple of days, I'm not really sure what that was with. It's only about, let me see, it's only about 6% from its all-time highs, and I think that maybe within the next couple of years, it could even break out into its all-time highs again. Now let's talk about the financial macro. Financials have taken probably the worst beating of any sector year to date. Private credit stress plus the new credit card interest rate caps from the White House have crushed the banks and lenders. The sector is looking extremely oversold right now, but the stocks aren't going anywhere until the broader US macro picture improves along with the economy. So I'm staying on the sidelines for here, but it is definitely something to take a look at. So if you want to take a look at this, we can take a look at XLF, which is the financial sector. And as you can see, over the past couple of weeks, it has really taken a beating. It is down about 12% from its all-time highs. And even companies like JP Morgan, BlackRock especially, which has fallen really hard, Visa, MasterCard, so all these financial corporations have just taken a beating over the past couple of weeks, and it's mainly just due to decreased consumer spending and lending because of the state that the economy is in right now. Next up is energy macro. The supply constraints from the Iran conflict plus the insane power demand from AI data centers equals the perfect mix for higher oil and energy prices. Oil companies and anyone tied to power generation are printing money right now as gas prices continue to rise. If you're not overweight energy yet, this is the spot to watch, but valuations are kind of high. So like I mentioned before, while the consumer is getting hurt from higher oil prices and basically every other company, the energy companies are raking in cash. If you want to take a look at XLE, which is the State Street Energy Select, you can just see that it has absolutely shot up over the past couple of months ever since the war with Iran started, and it is up almost 40%, which is crazy. And yeah, just take a look at how much this has just shot up in the past couple of months. It's actually insane. So now let's talk about another macro, which is the crypto macro. Crypto seems to be recovering well after its crash. Bitcoin and Ethereum ETFs are seeing massive inflows again, and regulatory clarity is looking better every month. And it could act as a fantastic hedge against sticky inflation and a potentially weaker dollar. The AI energy angle helps crypto too, as miners are benefiting from the same power boom that's lifting traditional energy, and also some miners like Iron or Marathon Technologies or Riot are positioning into AI companies as well. But let's also be real. Crypto is still tied to risk sentiment, so if tech sells off hard or rates stay higher for longer, Bitcoin could drop hard within a week or a month. My take is that the crypto will stay volatile, but has the highest upside of any sector once the Iran situation settles. So also, if you want to take a look at Bitcoin and Ethereum, we can see that these stocks are making a decent recovery. Bitcoin is up about 15% in the last couple of days, and it's just been on a strong run. Same with Ethereum, which has seen a larger uptick. These markets did fall heavily from their highs, all the way, especially Bitcoin, which fell all the way from 125,000 to about 60,000. Which is half of its value. But yeah, it seems to be making a recovery, but what people are worried about is that we may just repeat the same playbook. As you can see, we dumped, slight recovery, then dump again. So what people are looking for is a leg higher and not just this and then we go down again, which I don't think will happen, but anything is possible. So now our final macro is the defense macro. With the Iran conflict heating up, military spending is only going one direction, and that is up. Companies tied to missiles, drones, cybersecurity, and national security are seeing fresh orders and backlog growth. In uncertain times like this, defense is basically a recession-proof plus war premium combo, it's quietly one of the strongest sectors on the board right now. And this is especially true in like small growth companies. But as you can see, the aerospace and defense ETF has been absolutely ripping over the past couple months. It surged over 100% since April. And although it has slightly pulled back, yeah, it's still gone absolutely crazy. And yeah, that's just all due to war concerns and defense spending. So now let's talk about my overall theme. So overall, it's tough to make a strong bull case for the broad stock market at the moment. There's GDP slowing down, inflation sticky, the Fed's on hold, and a war that could push oil much higher, which would hurt inflation. But once this war ends, whenever that is, I believe that the market will recover quickly and we finish 2026 strong. And an important reminder is that even if the S&P 500 struggles, you can still make money by picking undervalued individual stocks or investing outside the US. You could do this by investing in other country ETFs. Take a look at iShares. They have a bunch of great ones. But first, let me do a technical analysis on SPY. As you can see, we have started to pull back in SPY after consolidating for what seems like months on end. I mean, as you can see, we were just trapped inside this range forever. Didn't really do anything until about last week where we broke out of it and we started to go lower, unfortunately. Now, while there still is this strong point of support right here, this could hold, but this would still mean that SPY goes down another like 2-3% from where we are now, which people wouldn't like to see, but honestly, pullbacks are necessary in bull markets. It can't just only go up. It has to go down at some points, guys. So just remember to always stay hedged. And yeah, guys, be safe in the markets as there is a high level of uncertainty right now. Thanks, guys. And if you have any questions about the macro or my opinions, let me know in the comments below. Thanks.